Bloomberg Audio Studios.
Podcasts, radio, news.
This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. This week on the podcast, what can I say? Brian Higgins has put together an amazing track record handling distressed and stressed debts, as well as other forms of credit, real estate, collateralized obligations. King Street is a fascinating firm. It was formed in 1995. Over the course of the past, 25 years, they've put together really an impressive track record. They have already returned about 80% of the net gains they've had to their limited partners. Really, there are a few people in the world who have a better sense of distressed asset credit, real estate, and how to not only do the fundamental research, but tactically trade around the positions. As an example, institutional investors mentioned King Street in 2022, perhaps the worst year for hedge funds since 08-09. They were down 3.8%. Their benchmarks were down. Fixed income was 15%. Equities was 20-something%. To be low single digits is really just a testament to their performance. There are a few people who are more knowledgeable about fixed income, credit, real estate, and distressed investing than Brian Higgins. I found this conversation to be fascinating, and I think you will also. With no further ado, King Street's Brian Higgins.
Well, thank you very much, Barry. I appreciate you having me.
I appreciate you being here. I've been looking forward to this conversation for a while. Let's jump right into it. You get a bachelor's in business administration from Villanova University. What was investing always the career plan?
Well, actually, I started out electrical engineering.
Me too. That's funny you say that.
First 2 years, electrical engineering. You graduate from high school. I'm good at math and science. And, I always had an idea I would go into business, but I felt that electrical engineering would be a good foundation. And that's what I started at. But after 2 years, it was sort of not very interesting. And I was intrigued by the markets at the time in the mid-'80s. You had a lot of stuff going on in terms of the merger boom, and Wall Street was rocking. And I said, hey, this is sort of interesting. I was probably the only electrical engineering major that had a subscription to the Wall Street Journal. Right. So my roommate, who was a mechanical engineer, said to me, what are you doing? Why don't you just switch over to finance? Which I said, sure. Makes
a lot of sense. So you come out of Villanova, you end up at First Boston in 1987 in the Special Situations Fund and Distressed Securities Group.
Yeah, I started out in banking, the 2-year banking program, which merchant banking was the group I was in. My co-founder was an analyst. He came out of Yale. He was in the bankruptcy advisory group. So we were in the analyst program together, 65 of us. And after 2 years, I went down to trade distressed proprietarily. I got promoted to associate without going to business school. I had done undergraduate business and felt that, hey, I can do this. But I want to get something different. Just rather being the analyst that never left, I want to get some markets experience, but stay in the proprietary side. So there was a proprietary trading group that was forming, and I joined that. And it was an interesting time in high yield, as shortly thereafter, Drexel, which goes from one day issuing commercial paper, and the next day they go bankrupt.
Right. So what was it like trading distressed securities in the late 80s? That had to be, a pretty, let's call it target-rich environment?
Well, I would say it was interesting because the market sophistication that we have today in terms of really the fluidity of capital structures, of trading desks, et cetera, the seamlessness, what you had. It was interesting. You'd see things go from, say, the investment grade market to the high yield market. There was a big disconnect as they moved positions that started to trade wider. The buyers didn't have the ability to go cross assets and cross, let's say, ratings as they are today. Mutual funds were very siloed, and now they're a bit wider mandates. So it was, yes, you had NAIC ratings changed for your insurance companies post Drexel, and so there was a number of less liquid markets that made for quite wide spreads. You had a default cycle, so you had trading with accrued and trading flat. And so there was certainly a number of different movements, but there was certainly downside of these things. So one had to be very rigorous in your investing, in your analysis to do the investing.
So you're at a big bank in 87. Obviously there were a lot of market dislocations later that year. What was that experience like for you?
It was interesting. I mean, it certainly was a indoctrination into the world of finance. You go from these big parties during the summer as you welcome to the new analysts to the market crash, obviously in October of 87. I think the volatility that ensued, and then the world's going to end, and then it comes back. I think that just spoke to the resiliency of the markets, but also certainly the volatility and fragility of certain sectors that one has to be mindful of. And I think ultimately there was a number of opportunities that came out. I had no money back in 87, but certainly some of the managing directors and other people that had some money, they made quite a bit of profits on some of the left for dead Microsoft and others that were just sold to very low levels.
So that sort of dislocation sounds like it was a formative experience.
Sure, and many of these things I look at growing up, gas lines in the 70s, and we had real recessions back in the 70s and 80s. Right. These days, it sounds like an old cranky old guy. But when that's the challenge of prosperity, that it doesn't really prepare oneself. Investors too, right? If you always have the Fed put, if you always have, just QE forever, that does have a lot of complacency. And you see it as you've gone from active to passive investing. People are like, well, why do I pay, for active investing? I could just, it's easy. And now as dispersion has increased in fixed income, I think it's brings back the active investing, but structurally there's a lot of money that's gone into to passive investing, which we believe will sow the seeds for the opportunity set for some time going forward.
And arguably, passive doesn't work nearly as well on the fixed income side as it does on equities.
Well, I mean, again, passive. It's nowadays. If you look at the big banks, they're doing portfolio trading with large swaths of their institutional clients. And so somebody will say, give me a triple B, single A exposure in these industries, and they go out and dial it up or down in terms of exposure. That creates opportunities within the trading market. So for our long-short credit hedge fund, there's dislocations and opportunities to trade to make money in those situations. But I mean, it's in these markets as we pivot going forward. Again, if you're saying I'm going to earn 5 and change percent, on my cash, and fixed income, no problem. Default rates are near zero. Now, default rates are kind of skewed a bit because you do have perhaps in high yield, if you look at with these liability management exercises and other restructurings out of court, it doesn't default, but then there's a lesser consideration you get for your claim. So it does factor into it. But, you've had a very benign default environment as we've had a lot of money printed for quite some time. If you look at the Fed's balance sheet, the M2 that has been printed, there's been a great tailwind.
Really interesting. So let's fast forward to 1995. What led you guys to depart and co-found King Street?
So going from First Boston banking, trading distressed proprietarily, then we started internal hedge fund at First Boston, and that was from 91 to 94. So if you think about it, I already had started, in effect, help form two of these businesses. And so at the end of 94, again, many issues with First Boston, which became Credit Suisse, which became UBS. I think I had 5 CEOs I worked under for the 7-8 years I was there. And so we said we could do this. And my co-founder and myself, we left around a few months apart, end of 94, formed King Street, started trading in 95. We never thought we'd start with the princely sum of $4 million, which is what we started with. We thought, oh, we're going to start with 50. All these people are like, yeah, I'll give you 5, I'll give you 10, no problem, and encouraging us to leave. So be it. We started with 4. One of the first $1 million came from Jimmy Kane, who was chairman.
At Bear?
Yeah, chairman CEO of Bear Stearns. I met him through another friend of mine, Vince Tisi, and knew him through golf and got to be friendly with him. And he heard what I was doing, and he said, I'm happy to give you $1 million of my money to manage, and you can use my name in marketing. And so, it was quite comical because I'd have back then a list of references, right? It felt like I was going for a job interview, asking for money back then. And we were 2 guys, 29 years old, as my brother called us 2 guys capital, and we would go around to all the usual suspects begging for something, and we ended up, as I said, with $4 million. But Jimmy took a personal pride, and and people would say, "You mean I can call this guy? He's CEO of Bear Stearns." And I said, "Yeah, call him up." So he'd call him up, and then immediately he'd call me up and said, how did I do? You get the money yet? So, it was very humbling. It was a very sweet, mentor of mine as a Irish Catholic kid. It was nice to have a rabbi such as Jimmy, and Vince, introduced us, and also Vince was incredibly helpful. So having 2, fathers of King Street, if you will, and they asked for nothing in return except the satisfaction that they received by seeing us grow and prosper, which was, again, very, very fortunate and blessed to have those 2 people in my life.
So from $4 million, you eventually grow assets over time to $27 billion. That's an incredible track record over 25 years. And I also can't help but notice it's been reported by places like Institutional Investor that you guys have distributed about 80% of those gains, which is really impressive. It tells me that you're concerned about scaling up too large. Tell us a little bit about why you kept the firm at a fairly modest size in terms of capital that you're trading.
Well, I think there's opportunities that ebb and flow, and I think it's important to have the right structure. And so we have a number of business lines. We have our collateralized loan obligation business, CLO business. Mm-hmm. That is super interesting business. It does help feed into our long-short credit business, which is our long-standing business that we started in 1995. We also have a number of drawdown businesses, drawdown meaning drawdown credit distressed businesses, and those have longer duration attached to them, which is commensurate with the opportunities we're investing in. We also have a real estate business so it used to be the credit hedge fund business had what's called side pockets. A couple of years ago, we removed them, and it's just the liquid long-short credit business, and the side pockets come in the form of these drawdown fund structures. That is something the industry has gravitated towards in the last, say, 10 years. And so,
meaning as each of those things mature, they get paid out to the
correct,
to
right.
the LPs.
Right. So you got 3-year, 1-year extension, perhaps, which 3-year investing, 3-year harvesting, and then pay out traditional, but they can vary. And so that's really having different buckets, and one has to, it gets complicated because you have different investors in different buckets, and then there are different vintages, and then they say, okay, I need distributions on, which vintage you do, and the timing. They can be, I don't have money this year for next year. So there's a whole planning that goes on in terms of when you launch different funds. But for us in the long-short credit business, there's lots of opportunities, as a number of the people that we used to see all the time in the markets are no longer around. And so that, we believe, has shrunk the competition, if you will, in the long-short credit trading business for distress. And I think also it's where are we in the cycle? Do we believe that there'll ever be a credit cycle? Do we think we'll ever have defaults again? Or, will we continue to grow, depending on your math, 1.5-2 trillion of deficits, and, then all these other amounts of debt around the world in the government side that is being printed to support global economies. I think at a certain point we see this competition for capital, if you will, between what the public sector, government sector, and the private sector is trying to. So I think it's going to be hard for rates to go low because there's still a lot of deficit spending out there. I mean, think about the deficits we have. when it's pretty much full employment, economy is still pretty strong.
What are we, 1.8 trillion a year in the U.S.?
Yeah, I mean,
Something
one
like that?
to some say two. So, I see different numbers all the time, so it's always kind of like whose math, if you will.
Really interesting. And it seems like everybody and their brother managed to refinance both household and corporations in the 2010s when rates were low, except Uncle Sam couldn't get around to it.
Yeah, and you say that I joke the greatest asset in many people's portfolio is their 30-year 2-3% mortgage.
Right.
And so affordability is been problematic because of the supply. We're short 5 million homes, but the affordability is still, because of that and other factors, has been difficult. So I mean, I think they're it's a complicated landscape on the consumer side.
To say the least. I mentioned earlier the Institutional Investor Lifetime Achievement Award you and your co-founding partner received. Tell us what that meant to you. That is not something that many people get tagged with. I think there have been 40 recipients of that from Institutional Investor. Tell us what that meant, that sort of recognition.
It's a incredible honor and an honor shared by all the current and past people that worked at King Street, and so we are some of the effort that has put forth over the 30 years, not just the partners, and also the investors that believed in us and continue to believe in us, and counterparties, et cetera. And it sounds trite, but it is very appropriate and true that we're just beneficiaries of some amazing people that we lucky to deem us worthy over the years. It's very humbling. It's very exciting. And it also, it's interesting because, there's always, well, why now? Why are you doing these podcasts or why would you do that? And I guess it's really, we have a story to tell. And I'm very proud of King Street and the people. And I think it's a great opportunity. And it also is a sign of the times of where we are. And I think evolution, personally and professionally, as a firm, as an institution, is so critical. And I think that's part of our staying power is our desire to continuous improvement. And, you look back and people might say, well, why do you focus on the past? Well, focus on the past so that there is a future. I think the Lifetime Achievement Award is kind of, I thought they give it to dead guys, whatever, but we're not dead yet and don't plan on ever being. So we're excited about the going forward.
I like that concept. You don't know where you're going unless you understand where you've already been. Makes a lot of sense. Let's talk a little bit about what you guys do. You mentioned earlier stressed and distressed. I know that they're two very different things, but there's some nuance there. Help us understand the distinction between stressed assets and distressed assets.
Yeah, I think it is kind of nuanced in a way. I think, distressed assets, you're on your way to default most times or restructuring. Stressed assets, can be out of favor assets. I think you're splitting hairs. Some would say, oh, triple C bucket, that's all distressed. And if you're looking single B, double B, oh, that's stressed. I think it also depends on where we are in the cycle, what can be stressed, distressed. And also, if you look at a stressed infrastructure situation that might not be that wide in terms of total spread. So let's say you have 1,000 basis points over the Treasury is a distressed situation. And then if you look at something that normally trades, say 100 over, but it's trading at 200 over, and that could be stressed. Now you would say, well, that's in high yield, that's nothing. We can see a 20, 50, 100, 200 spread widening or tightening, in high yield. Now that is, I'm giving a historical perspective. It seems like the last couple of years, this is not your father's high yield market when they, high yield meant junk bonds. And these days, high yield is trying to be an investment grade market given the security.
5% is high yield these days.
you had the Fed come in and push a lot of the banks and say, hey, you can't have a ton of leverage on the high yield issuance. And so they kind of helped create the private credit market, if you will, where it went into loans. And so, and lack of covenant protection. But the quality of the high yield market is dramatically different than, once I came up.
So it sounds like it's not so much that there's any real distinction other than a spectrum of riskier debt is going to have a higher yield, but greater risk that comes along with it, and distressed are just different points along that spectrum. Is that fair?
Yeah, I think that's fair. I mean, again, I'm sure some would have their own classification system, as it were. I would just liken it into, distressed is, real operational issues or financial issues that, as I say, inevitably preponderance of outcomes is to a restructuring or a bankruptcy, out of court or others. And so versus distressed, which is not always heading that way.
So let's delve into not your father's high yield market. How does the high yield market differ today than when you began in the 90s? And how much credit or blame lay at the feet of the Federal Reserve?
Well, I wouldn't say it's the Fed. I think the markets have evolved dramatically. And if you look at markets around the world, the U.S. capital markets are the envy of the world because the banks have had less and less responsibility, if you will, meaning they're 25% banking, traditional banks, and 75% capital markets, which would be, all sorts of bonds, private and public. You go to Europe, it's 75% banks. You go to developing markets, it's 95, 100% banks. And so they're more susceptible to boom and bust because there's that lack of, cushion and, and the more systemic in terms of their issues when the economy turns. But if you go back to the question on, high yield and how it's differentiated, there was just a lot more leverage back then. I remember doing the Allied Federated deal. Now, granted, the risk-free rate was higher, but you had, 16% loans, 70% loans. You had, 8 times, 10 times leverage, right? So you have less leverage, you have lower spread going in, as I said, a higher quality. And the greater leverage is being found at times in some of the private credit or other loans. But I think this extreme leverage is not as prevalent as it once was. And so I would argue that the markets have been more rational in terms of their approach to leverage than ever before, at least my almost 40 years doing this.
So you also talked about the U.S. markets versus Europe and emerging markets. How much credit goes to places like the FDIC or the SEC, or is it just the full faith and credit of the U.S. government standing on top of a very healthy macro economy?
In terms of the market construct, comparing U.S. versus the rest of the world, I think, there's a lot of credit due to the innovation, open regulation, but also, evolving regulation. And also it helps having these large banks. If you look at, there hasn't been the big bang in Europe as they said it was going to be, right? You look at the wrestling going on between Unicredito and Commerzbank, and you look at the German banks and some of the issues, the stagnant aspect of that economy. If you look at savings products over there, there's not the full depth and breadth of products that we have.
Even money market. You don't have money market funds to the same degree you have them here.
Correct. And a lot of times they do it with, like you have Japan Post, you have Italian Post, you have Deutsche Post, you have, the regulatory environment for asset management in Europe is quite onerous and is difficult to passport. I mean, they have that these days, but there's still, the reality is there's still a lot of inflexibility within the regulatory framework that, and look, I've spent a fair amount of time with regulators and central bankers and participated in a number of forums and meetings on the topic. It does get complicated because Europe is Europe, but it's still a number of different countries within that. And the U.S. having this large, deep market does help. And look, I think we do have the innovation and sophistication, and I think the beneficiary of it is the world being able to buy sophisticated products that really are solution providers in all ways, shapes, and form.
So I want to delve a little deeper into what makes King Street so unique, not just its performance, but the way you guys approach the world. You combine a fundamental approach with very disciplined and opportunistic trading approach, which is, usually those are two totally different animals. It's interesting to see, especially in credit and stressed and distressed, see those two married. Tell us a little bit about how that set of strategies evolved and what sort of opportunities it's created for you.
I think going back to history, which is 1989, well, so you can go back to 87 with the crash, seeing the importance of tactical trading. Go back to 89, the formation of the prop group, the Distressed Securities Group, on the trading desk, but being part of that when you had very wide bid-ask spreads. And you could see that execution and entering and exiting a position, there was a massive amount of differentiation and performance that could be created if one were to be able to trade it tactically. So, for example, if things go quite wide in spreads where they can trade 10 bond points wide, being able to buy on the bid side versus the ask side, if it's 50-60 market, for example, that's 20% differential.
Wow. So
just your entry point is massive. And also, we call ourselves short-long investors, and people say...
As opposed to long-short.
Correct, because many of our biggest longs started out as shorts.
Uh-huh.
And why that's important is...
Meaning you cover the short and then go long.
Correct.
At the end of the short trade.
Right.
It's like, if it's good enough to cover, maybe we want to completely reverse our original views.
Right. And so initially, there's always and we could sit there a bit of time, and it gets expensive carrying shorts, so you have to be mindful of that. It can take some time. However, it does enable us to have done a fair amount of work in advance. And so let's say something breaks. Hopefully we've been short it, and we have a fair amount of institutional knowledge about that situation. And then we can cover it or wait, it's going to get worse. Because, oftentimes management comes out and they say, okay, they find some guy, they shoot him and say, that was the bad guy, and now we're back. And you're like, wait a minute, that guy, was the janitor. What do you mean? Or we're going to execute on this or that. And you say they've tried to execute, for the last 3 years, they haven't been able to do it. So it really, having a bit of perspective is important. And then you can then time it appropriately. Now, we're not market timers, but it does give us, I think, a relative value perspective. So coupling the trading and understanding, okay, a lot of sellers are coming out, there's more coming out, having that supply-demand question answered is important as well.
So I want to put some flesh on the bones of what it looks like combining the tactical with the fundamental. And I'm going to quote numbers from institutional investors because I know as a regulated entity, I know what I cannot say. I know you can't give specific numbers, but I could cite what institutional investor had observed. 2022 was the worst year for hedge funds since 2009. The S&P 500 down 20%, bonds down 14%. King Street, according to II, was down only 3.8%, a massive outperformance to either the S&P or the Bloomberg Ag. Tell us what it was like trading in 2022. First time in 40 years, stocks and bonds were down double digits together.
I would say it set the table going back to, say, 2020. If you look in the pandemic when, world was going to end, and then you had a lot of liquidity injected, and then we had the vaccine news came out and everything rallied. But there was so much stimulus being put. And I think, just let's say I don't like losing money ever. And as my co-founder used to say, relative performance, but you can't eat your relatives. So it's just important to, from our perspective, contextualize that. And so we are very disciplined. I think one of the things that we looked to was like, hey, let's go up in quality, up in liquidity. And that was a concern. I think one of the things that took us by surprise was, okay, how much inflation really rooted and how quickly and how high it went. So I would say, that was something we missed. Again, we always try to focus on what we did wrong and we correct those. Hopefully then the going gets better going forward. Trading in 22, it as I said, I wouldn't say it's too differentiated. But again, in absence of a true distress cycle, I think then it loses sort of meaning. But if you look at, in 2020, there was a number of things that is really, for me, a more signature important time.
So I want to talk about a few specific investment strategies that King Street does. In 2017, you launched a collateralized loan obligation business. Tell us a little bit about that strategy.
So we've been investing in CLOs, mezzanine, and opportunistically for a number of years, equity and et cetera. We've always had this credit expertise, and we felt that as a complement for our investors and to benefit our long-short credit business, to have the CLO strategy was, we think, a distinct advantage. And so we've had a terrific growth and successful business launch and continue to grow from strength to strength there in both the U.S. and Europe issuance. During 2020, there was a number of opportunities that came out to rescue finance a number of the companies we had relationships with. And so it has proven very complementary to our business. We describe our business in terms of overlapping circles. Mm-hmm. And that is that we'll have different fund strategies, and there might be a bond or a loan situation that we might see in different funds if they meet the investment criteria, liquidity, duration that we are looking for in that particular strategy. And so there is real synergistic effects and ability to analyze these situations quite rigorously.
Let's talk about another overlapping business line, real estate. What do you guys do in the real estate space?
So we've been doing real estate, as we mentioned, first real estate finance and then real estate buying the equity or buying actual properties for quite some time. A number of years ago, again, as I mentioned earlier, the demise, if you will, the stop doing side pockets, and you set up separate real estate funds. And so we've set up a number of funds. We've also invested in some specialties such as student housing in Europe. We've done last mile logistics. We've done movie studios. We've also done a number of financings as the banks have pulled back, has created great opportunities in that. And then more recently, we bought a data center business that specializes in AI and high-performance compute, which is quite an exciting business.
That's Colivor?
Colivor, yes.
I was reading about that and saying, wow, this seems to be, a little off of what I was expecting. Liquid-cooled AI data center. Liquid-cooled, what's that about?
So to give you the history, so years ago, we started focusing on growth lending, growth financing. It's funny, VC, distress, there's a lot of similarities between the two. Mm-hmm. You don't know what's going to happen with the company. Is it going to make it, not make it? So, for example, Airbnb and DoorDash. Mm-hmm. In 2020, we lent them money prior to their IPOs. Now, the V on the LTV, loan to value, the value oftentimes there's a disparity because when you ask a tech person what's his company worth, generally it's very, very high numbers, which we don't always support from our valuation. But if the loan percentage is quite small, 5-10%, then there's a margin of safety, mm-hmm. And we have a lot of covenants to protect ourselves. Needless to say, we did some of that. We looked at GPU financing, which GPU is the NVIDIA chip. That's what they produce. And so we looked at some financings there. Couldn't get quite comfortable the depreciation curve because, NVIDIA comes out every other day with a new chip.
Right.
And so we said, why lend your money if every 2 years you're going to have a new chip? And so worry about the value eroding on that chip. And so even though we over-earning in terms of financing, now there'll be situations and opportunities that will make sense to lend in that sector. However, we then said, wow, this data center business is going to have legs for quite some time. We looked at the hyperscale business, insanely competitive, and said, okay, can't make a mark or find an edge there. And that's when we came up with Colivor, which was selling itself. They had been doing liquid cooling for 13 years. They started the company 13 years. The company 10 years ago, operational in a co-location business in Santa Clara, California, in the heart of all these tech behemoths. And they've been DGX certified by NVIDIA for over 5 years. Liquid cooling, the way we do it, is it's full, true liquid cooling. And
meaning it's more efficient, more productive.
Yeah, so just think about just the construct, right? So you have the whole data center, you have 3-foot raised floors, you have a intake, outtake of water that's ambient water temperature, flows around and goes to the rack. Many will do liquid cooling to the rack, but separately, and that's very expensive because in effect you're retrofitting. 95+% of the data centers are air cooled. Mm-hmm. As we know, water is 3,000 times more effective cooling than air. And so the PUE, which is the efficiency rating that they utilize, we're like 1.3, and many are 1.5, 6, et cetera. So it's very efficient. You can have a denser facility, and it can handle the AI chips. The other metrics that people use is the kilowatts per cabinet. And so we can host up to 250 kilowatts per cabinet, where 5, 10, 20 is these traditional data centers, air-cooled. And so, as Wayne Gretzky used to say, I skate where the puck is going to be. And the chips are all about we need liquid cooling. Also, as we look to satisfy the future, which will be inference versus the LLM, the big training models, there will be a need for the data center. So we're having a number of conversations and across many different verticals. Our real estate group is executing, plus the team. It's super exciting, and it's something that evolved out of our overlapping circles with the financing. We don't. There's always a method to it that we evolve into.
Really fascinating. So let's start out talking about why we're even talking. For most of King Street's history, you've been a quiet firm. You quoted one of your colleagues as saying, "Hey, it's the spouting whale that gets harpooned." Tell us why we're even having this conversation now.
Evolution is so important, self-improvement, evolution. I think markets change, and I think it's important to adapt to survive, as the trite saying might say. We look at the opportunities that we're facing, the business that we're building and have built, and are quite excited about it. And I think it's important to communicate for our investors, for prospective partners and people that to attract the best and make sure we have the best partners, to make sure our story's out there. It's gotten incredibly noisy, if you will, and everyone's out there. So to do nothing, I think, would be a disservice to the people in the business and our partners, really. As the opportunities come to as they say, squeaky wheel gets the grease, and so one has to relationships are great. However, at times people would say, "Oh, King Street, they still in business?" Because if you're not out there with your LinkedIn presence or I think it's just a sign. Look, we're not on Instagram, so
no TikToks from King Street?
No TikTok videos.
Right. Really, really interesting. There's some quotes of yours that I really like. One of the things you had said recently was, "What kills you in investing is a false sense of bravado. I have all the answers. I could beat this market," or that sort of approach. We say the work is never done and knowledge reduces risk. Explain.
Well, it's from our perspective fairly simple. As investors that focus on out of favor, distress, bankruptcy, we see failure every day. And we would be incredibly delusional to think that without and sometimes it's no fault of the companies, right? It's some unforeseen act. It's some fraud was perpetrated on it, but it's incumbent upon us to be tireless in our effort, as there's multitude of competitors out there globally that we go up against every day, and if we're not grinding it out, then there's there's going to be a shortfall, and we don't plan on having that.
Early in your career, someone would ask you what drives you, and your response would be paranoia and insecurity. Along the same lines?
Yeah, look, paranoid insecurity. It's I try to be humorous and colorful because investors come in and to drone on, that it doesn't always keep their attention. I think it's important to look at. We also talk about probability and proportionality. And so if you take those four things, right? So the paranoia insecurity is like, okay, did I do enough work? Does someone else know what can happen that I'm not seeing? It keeps that drive to continue to ask those questions. As we said, knowledge reduces risk because, this is a moving picture. This is not a still life photograph. And so there's many different variables that happen through a business, through a cycle, through lifetime of owning an investment, and markets do change. So if you think about the number of variables, one would be kidding oneself to think that they can rest on their laurels, if you will. The work just begins when that investment is made. And so in the paranoia and insecurity, only the paranoid survive, as they say. And so we have to say, did I do enough work? Was there something I missed? Keeping one up at night, that constantly looking at it. I think if you look at any piece of work, an artist or whomever it is, they put some work, they do some work, they put it down, they come back, they look at it from another light, and they're, I missed that. Let me continue to refine it. And so investments in our mind are bodies of work that need to be continually refined because the elements, if you will, continue to challenge it. And then you look at probability and proportionality. One has to be careful on that, right? Because if you say, well, this hurricane is going to happen, the tragic hurricanes that we've had currently and just recently. Okay, if you had said, never going to happen, we haven't had it for a while, and if it happens, it doesn't create much damage. Well, what's the probability that could outcome? Now, if you look at geological faults and you're buying a piece of property and you're building a data center, for example, and you say, well, 1 in 1.6 million or billion years that,
right.
I feel good about that, right? But if you're down in Florida and you're saying, I'm not going to buy flood insurance, now, question, can you get it these days?
Or afford it, right.
Afford it, right. But think about the people, the tragedy happened in North Carolina up in they didn't think they'd need flood insurance.
They were deep inland and at a fairly high elevation, and yet they still got flooded out.
Right. So these are things in terms of proportionality and probability. And proportionality is, okay, you can create a scenario with any investment where you'd never make the investment. Mm-hmm. You could say, well, that could happen. And then you could say to someone, well, it's 1 in a million years and it's 2% of the business. Is that really going to cause you to pass on that investment? So that's the constant interplay that we feel is critical to arrive, at the best decision you can make. And again, the best decision you make today, tomorrow, look at it again and say, I screwed up.
You mentioned earlier you wanted to be a little public because you want to attract and retain the best employees. King Street has about 250 people working for them, 70 of whom have been with the firm for 10 or more years. That's pretty unusual in the hedge fund world. Tell us a little bit about the 10-year club you guys created.
Well, it really, again, as I said at the outset, it's celebrating the people that comprise King Street. As I thought from the beginning and talked to other people in leadership, remember that your greatest asset, goes down the elevator every day and you hope they come back up the next day. And so one has to, again, celebrate the teamwork. And that's the approach that we have at King Street. I talked about the overlapping circles and the ability to work on different aspects of the business, but it's very much a team. And we look at what the operation team, the investment team, and the trading team. There's a lot of collaboration that is constantly occurring, and people get paid on the well-being of the overall firm. And so it forces that teamwork and collaboration. And I think it's important to celebrate events. We have outings. We have different groups celebrating our women, our diversity, our charitable pursuits, our holiday party. We still have the old school holiday party that we do every year. I think the summer outings, etc., these are all, we believe, part of the building culture. Everyone, the month end, everyone's birthday gets celebrated with we had them happen every day. So we say, wait, we'll just do it once a month. All the February birthdays, and then you got to vote on it. So little things that I think create the family, and you spend a lot of time with people, and if there's not that recognition of individuality and the effort put forth, then it's a miss. We believe it's again, to celebrate together what we've achieved is critical.
I've heard a number of executives complain, or at least raise the issue. It was very difficult to either create or maintain a corporate culture during the pandemic, work from home, remote. How have you guys navigated that, and how important is corporate culture to a fund like yours?
Well, culture becomes what it becomes. Everyone hopes that their culture is sustainable and constructive and not toxic, and so we strive to make sure there's that communication, openness. We do a lot of surveys. We've always trying to better our scores. It's self-improvement we focus on. If you go back to the pandemic, it was hard, right? Because you're on Zoom. And so, holiday party on Zoom, or, scavenger hunts on Zoom. It was, how do we create these ties that bind us over what it was incredibly challenging personally and professionally for a lot of people. And frankly, the markets, as we all know, back in the 2020, as I referenced earlier, were brutal and working incredible amount of hours. The family challenges that people had with their kids at home or trapped in different places, and the sicknesses and loss of life. So those are obviously in any regular time important, but we believe corporate culture has to play its role, and not to replace, but to be a part of it, to be supportive of people. But it's and also think about, like, we have offices, as you indicated, in the U.S. and in Europe and Asia, Middle East. How do we create that consistency? How do we create that fabric that runs throughout? And it's a lot of times we'll do our similar furniture and the like, so they feel like, oh, this feels like a King Street office, things of that nature, similar events and the swag, if you will, that binds people.
So your co-founder and partner, Francis Biondi, retired a couple of years ago. Two questions about Francis. First, is he still sitting on the Yale Investment Committee, or has he fully retired from asset management? And then second, what was that transition like? Suddenly, your co-founder is no longer there every day. How did you adjust to that?
Well, I believe the website's correct. He's still at Yale. I know I've spoken to him recently, but I know he's got a lot of pursuits and quite busy and with his family, and I think he's enjoying and well-deserved time. He and I had an incredible 25 years together. We called ourselves, old married couple, or, brothers of King Street, whatever they call us in II.
Two Guys Capital. Two
Guys Capital, right. So, which is funnily enough, my brother named that. We grew up in New Jersey and in East Brunswick, and there was Two Guys, which was
the giant Alexander Calder on the outside of that building. Am I remembering that correctly? In Hackensack?
Well, I grew up in in East Brunswick, so I don't know about the Hackensack one, but in the one, it was a discount store and went bankrupt in the 80s. Which Vornado was part of the portfolio, became then the so it's funny history. But my brother recently gave me a shirt, a Two Guys Capital. I don't know, we got it on the website somewhere, but anyway, so I had a significance there. But no, so as I said earlier, having this team and this partners with us over 13 years on average, and having MDs, 38 plus MDs with us over 10 years on average. We've had a very deep bench, and fortunate to have incredible depth and breadth to the organization where we didn't miss a beat. And, that's something, I think, testament to the culture that Fran and I built the first 25 years, which we hope will continue for many, many years to come.
Let's jump to our favorite questions that we ask all of our guests, starting with, what have you been watching these days? What's been keeping you entertained?
Well, I've been watching the Mets a bit lately. I went to my first Mets game
in October, which I can't remember the last time you could watch the Mets in October. Having grown up on Long Island.
Yeah. I mean, I grew up in New Jersey, and my first Met game was 1969, which was when they won the World Series.
Yeah.
From a despicable, worst team ever. I think the Chicago White Sox have taken that over. But anyway, so we went, there, watched some of that. Also, I'm a Knicks fan. Went to Villanova, and they call them the Nova Knicks. Funny story, years ago, I was fortunate enough, Jay Wright, who's the coach of Villanova, invited me to speak to the team before the start of the season. They were in New York, and, talking to the team, and I said to them, guys, I'm really, really nervous here. 2018, they were reigning national champions, and if you guys don't win the championship, they're gonna look at me and blame me. And they were kind of looking at me quizzically, and I picked one of the young players, young freshman, and I sat down right across from him, right up in his face, and I said, look, I'm really nervous. I got this big meeting, and you got to help me. What can you? What do you say to me? And he had deer in the headlights look. He was 18-year-old kid. He was sort of like this, old guy with supposedly, successful guy coming in begging me for advice. What do I, And he said, quizzically, you can do it? And I said, yeah. And it was funny watching the faces of all the older upperclassmen, and they were laughing because they knew I was just trying to see. And I said, it was interesting because Jay Wright had called me 4 times in advance because it was so, but you go back to leadership and culture, it was so important he wanted to make sure what message I was going to give. And I said to the team, I said, see, you all can be leaders. You all can inspire. And when you're on the court and Jay is, 50, 100 feet away, who's going to inspire and lead each other? And you can't just rely on the coach. You got to look to each other for leadership and to sponsor. And that's when I talk to my team and how do we have the culture, how do we continually have that leadership? If the partner's not in the room, who's going to take that mantle and who's going to push forward? And so on the things that I ingest, I got to have a lot of intake to have outtake, right? Because I got to do a lot of meetings. So I got to find that time to refill the tank with information. And so, on stuff I'll watch, if it's not sports, it will be some mindless spy things. I like because I like to travel and see things around the world and different cultures and understand that and history, and so that usually wraps up in, say, a spy thing.
I'm going to give you a recommendation only because I watched this on the flight back from Europe, and it's dead center of what you're talking about. The Ministry of Ungentlemanly Warfare is essentially Churchill's special teams creation as a way of fighting Nazi submarines during World War II. If you like global spy stuff and history, this is right in your sweet spot.
I wrote it down, and we'll put it on the list for sure.
Absolutely. And again, we're recording this in October. I can't remember the last time I was this excited about a Knicks season. Even injured, they really distinguished themselves last year's playoffs. You could see, hey, if they were full strength, they could have gone pretty deep into the finals.
Yeah, I'm super excited for this season and sort of seeing what they can do as well.
So you mentioned some of your mentors. Tell us about the people who helped shape your career.
Well, I mentioned Jimmy Kane and Vince Tisi. Vince
Tisi was where?
Vincent Tisi is on the number of boards to this day. He was banking commissioner, state of New York. He was urban development chair. He had been tax lawyer. He was commodities trader. So he had this incredible varied career and life, and quite successful entrepreneur. And so he's always a wealth of information, contacts, and always great advice and perspective. And Jimmy, of course, ran Bear Stearns, obviously unfortunate ending to a storied career, but he too was very helpful in giving great advice.
Right. Legendary CEO of Bear Stearns. Let's talk about some books. What are your favorites? What are you reading currently?
I would say book-wise, just let's say a genre in books, because I listen to them. I'm not a big reader because I read so much in terms of research and consultants and sell side and our own internal research, plus the papers, et cetera. And I try to ingest a lot there, and then content, deeper content on the weekends. And then, just number of emails, et cetera, you go through. So I'll listen to different, whether it's leadership or self-help type things, but it's more about, I think, the self-improvement. And so how do you get the most out of life, if you will? I love hacks, if you will, in terms of health hacks or, efficiency hacks. I think that's critically important technology to utilize to its fullest. So that's sort of the focal point.
Let's talk.
And by the way, on that, I found that Blinkist is a great thing to utilize because
the website.
Well, Blinkist is sort of the Reader's Digest version of books, because most books, they have a concept, interesting concept, and they spend 200-300 pages saying the same thing 7 different ways. Trying to convince you that versus Blinkist is like, all right, here's the concept. And you're like, okay, makes sense, interesting, and next.
One of my partners likes to say most books should be magazine articles, most magazine articles should be tweets, and most tweets should be deleted. And that's his same sort of concept as Blinkist. So now we're down to our final 2 questions. What sort of advice would you give to a recent college grad interested in a career in either stressed or distressed investing?
Well, there's the critical importance of analytical rigor. And so if you're a recent college grad, you can't necessarily go back and take the courses that would be helpful. And so if you see some of the Ivy League kids, they don't have the accounting background, for example. I think critical thinking is important. I think having some understanding of the legal framework as has always become such a big deal. To get into, let's say, stress, distress, out of favor, look, there hasn't been as much interest, frankly, because the tech world's been such a robust world, and so it's important, again, as I said, to work in the credit business to understand those covenants, understand those companies, to get a generalist type experience, because one never knows. Is it the utility sector? Is it the energy sector? Is it the TMT sector that will have issues, or asbestos, or different issues? And then you're like, oh, I'm an expert in this. But at the end of the day, if you understand cash flow generation, you understand balance sheets, you understand legal framework, accounting, then you can kind of learn most valuations frameworks.
Really interesting. And our final question, what do you know about the world of distressed credit today you wish you knew back in 1987 when you were first getting started?
Well, I guess having the hindsight is 20/20 perspective on markets in general, I think it's important, pivoting globally, also let's say the broad product suite that we now have, I think are super interesting and informative. I never would have thought that we would rebound so easily and quickly in so many different difficult times, and that kind of me speaks to the resiliency, of markets and the the commitment that the governments, et cetera, had to bail us out time and time again. And so now $35+ trillion of debt. We got a massive amount of debt and to show for it since 2008. We'll see how it all works out. But I think it's really the sophistication and innovative nature of, let's say, security design has been enabled to have the flexibility of capital that has been transformative, certainly for the U.S. cap markets, and then finds its way into other markets. But it enables, people say traffickers in tragedy. It's interesting. We had, one of the investors going to allocate to ESG, and he said, well, distress is not ESG friendly. I said, well, we're 100% ESG. We're trying to help companies survive, and they have bad ESG score. We're trying to transform them into productive companies that are doing better. Think about the environment. They might have had some spill that they had a big liability from, or the governance was bad. That's why they were in distress, because some guy was stealing money or what have you. So there's a number of things that we've been able to improve upon, bring in new management or cleaning up environmental issues that then the company valuation rebounded.
Thank you, Brian, for being so generous with your time. We have been speaking with Brian Higgins. He is co-founder and managing partner at King Street. If you enjoy this conversation, check out any of the past 500 or so discussions we've had over the past 10 years. You can find those at iTunes, Spotify, Bloomberg, YouTube, wherever you find your favorite podcast. And be sure and check out my new podcast, At the Money. Short 10-minute conversations with experts about specific topics involving your money, earning it, spending it, and most importantly, investing it. At the Money, wherever you find your favorite podcasts or in the Masters in Business feed. I would be remiss if I did not thank the crack team that helps put these conversations together each week. John Wasserman is my audio engineer. Anna Luke is my producer. Sean Russo is my head of research. Sage Bauman is the head of Bloomberg Podcasts. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.